Welcome back. Analytical procedures are one of the types of audit procedures and audit evidence that we identified in our last video. Because analytical procedures are increasingly used and are becoming increasingly important in audit practice, we consider them separately here. The 500 numbered auditing standards are ones that deal with audit evidence. We saw ASA 500 on evidence was the umbrella standard. ASA 520 deals specifically with analytical procedures as a form of audit evidence. So analytical procedures means the evaluation of financial information through analysing plausible relationships among both financial and non-financial data. APs also include any investigation that is necessary because of fluctuations identified or relationships that are inconsistent with other relevant information or that differ from expected values by a significant amount. Types of APs include simple comparisons of balances, for example, last year's versus this year's balances, financial statement ratios, which you've learnt in many of your other accounting studies, common size statements, trend analyses, comparisons of financial and non-financial data, and some other more sophisticated statistical techniques. So, what do we use APs for? We use them to help understand the client's industry and business, as ASA 315 requires us to do. We use them to help assess the client's going concern status. We use them to identify anything that's unexpected. That is, we say that's an increased risk of material misstatement. We can use APs in our auditing to reduce the amount of detailed testing we do of our transactions and balances. And then finally, the timing when we use the APs. So we use APs at 3 stages of the audit. We use them at the beginning of the audit, the planning stage. We use them during the audit for testing, and we use them at the end of the audit as part of our completion procedures. So this diagram, figure 5.2 from Aaron's chapter 5, shows the relationship between the purpose of using analytical procedures and when we actually use them across the 3 phases of the audit: planning, testing, and completion. So the basic rule about APs is that they are mandatory at the planning stage of the audit. The standard says you must use them. They are mandatory again, so required, you must use them at the end or completion phase of the audit. So at the beginning or the planning phase of the audit, we'll see examples of this in our class this week and also in future classes looking specifically at audit planning. The main reason that we use our APs here is to get our overview of the financial position and performance of the client. Okay. Secondarily, we use it for assessing going concern. So what, for example, the debt to equity ratio looks like, what do the client's cash flows look like, to help us make a preliminary judgment about the validity of the going concern assumption. We also mainly use APs at the planning stage of the audit to see if anything looks unusual or unexpected, and that directs our attention to where we're going to plan to do our testing, because anything that's unexpected or unusual is an indicator of an increased risk of possible misstatements. During the audit itself, we can use analytical procedures as a means of reducing extensive, detailed, what we call substantive testing of account balances and transactions. So areas where the balances are not that great or that they're low risk, APs may provide sufficient appropriate evidence, or they may complement the additional more detailed testing. Then at the end of the audit, we reapply our APs to see if we are still comfortable with the reasonable assurance that we've detected the material misstatements, and at the end of the audit we again reassess going concern. So the difference between using the APs at the beginning of the audit and at the end of the audit is at the planning phase we are applying our APs to the client's unaudited data. When we get to the end of the audit at the completion phase, we are reapplying the APs to the audited data to reassess and reconfirm going concern and to see if it all looks reasonable as a whole. So how the auditor actually goes about applying APs is that first of all, the auditor has to come up with their own expectation of what a client balance should be or what a financial ratio should be, and then makes an appropriate comparison. So it could be comparing client data with industry data. It could be comparing client data with the same data from the prior period. It could be comparing the client data with client determined expected results, so for example with budgeted numbers, or comparing it with what the auditor is expecting. And then finally it could be comparing it with expected results but using non-financial data. So any comparisons which result in an unexpected result, so the result is different to what the auditor expectation is, the client's numbers are different to the auditor's expectations. If there's a material difference, then there's an increased risk of material misstatement, and that directs the auditor's attention as to this is where I have to plan to apply my audit procedures and investigate further to come up with an explanation for this unexpected result. So that's how an overview of how analytical procedures are applied in the audit. They are required to be applied by the standards. They're required to be applied both at the beginning and end of the audit, and of course are also used during the audit to provide audit evidence. And that concludes our coverage of the auditor's responsibilities, audit objectives, audit procedures, and audit evidence.